Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
What that means is going forward, they're done with the 75 basis point hikes. Now we're looking at 25 basis points, right? So it's no longer going to be that big hit to try to just super slow everything down. Now, from there, what it's going to be is, all right, the extent, right? How long as appropriate. So what we could see is, and personally what I see is they've got the next March meeting is in March 22nd. I could really see them doing another 25 basis points at that meeting. And then from there, trying to settle in. Let's see what happens from there. So, but again, for those maybe just joining, when Jerome Powell speaks, and I did a video on that this week as well, when the Fed speaks, they are not talking about mortgage interest rates. These are your short-term loans, right? These are the things that where, hey, affect your credit cards, affect those types of things. So that's what I want you to understand when we're talking about this. And we could get into some data and all that stuff about the credit cards and all that later on, right? Because it's almost the new elephant in the room, right? Is the credit card debt. And you know what? It's not by anything you've done, except the balances that you had aren't at zero anymore. And I think you mentioned last week, what is it, James? It's 19. The average.
It was 17,000 per household. The revolving was more like 7%. No,
right?
$7,000 per household. The percentage was 19.33.
All right, but let me ask you this: what was the and I'm pulling up some stuff.
Sorry, I thought you were going to ask about the balance. The average balance is 17,000. The average that revolves is a little over 7, almost 8. So, and the average percentage rate is up to 19.33.
All right, so listen to this, and this is why mortgage gumbo. This is why it's no secret. You don't do it because of my looks. But here's why, and here's what we keep you updated on, right? Americans' total credit card balance is $925 billion in the third quarter of 2022. That's a $38 billion jump over the first quarter. And it's probably not people, you're using them at the same pace, but now if you're not paying them off, that average percentage has gone way up. Since the third quarter of 2021, credit card balances have risen $121 billion. That's 15%, folks. That's the largest year-over-year jump in 20 years. 20 years. So what we have to understand is this, and this is where we talk about on this show blended rate. This is where for you listening going, man, I ain't got to listen to this dude. I got 3.25. Ain't nothing he could do for me. Keep an eye out because a lot of folks are starting to call now. Because what do we talk about? Those who are refinancing that debt is one of the 4 Ds. And don't get yourself in trouble with this debt. Let's at least look at it. Now, a lot of us, you may not be there yet. A lot of people right now, James, and for you listeners are thinking, I got this under control. This isn't nothing. I'm going to pay that off. I'm going to handle that. And I hope you can. But just know if you have questions, snapsendandsave.com, and we'll look at it for free. I will let you know if it makes sense. There was 3 people this week. I said, sit tight. It's the same thing I'm doing for all my buyers last year. I'm not calling them right now going, hey, it's time to refinance. Because it's not. Because, see, unlike most lenders who are desperate and they're trying to just get loans wherever they can do them, when you do right by people, you stay busy. You stay productive, right? That's a better word. So right now, Mortgage Gumbo, we're making dreams come true. My thing to you is let's look at and review, is it right for you? Because like I just said, I had people this week where I said, stand pat. Not yet. Let's look at it, right? Can you manage? Because the bottom line is return on your money is more important than return of your money, right? So, I mean, I'm sorry, return of your money than the return on. My bad there.
All right, cut to from Jerome.
Yep, go ahead.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all.
See, now what I think he should have said right after this is now that I just said that price stability is, the measure of whether or not we're successful, I owe you all an apology, because the fact that we have 6% inflation right now means we're an abysmal failure, and I should probably resign and step down and find someone else who can do a better job.
He
didn't say that.
Yeah, he can't come on and go, look, I put us in this situation. I filed up. I sat back, smoked cigars, went to Wyoming, hung out with all the other Fed chairs, and didn't do crap for a couple years, right? I was busy refinancing all my houses at 2%. So I had to make sure all my investments were handled, and then I could go. And that's what we talk about all the time. And it's unfortunate, and I want to believe in the good, but there's probably about 12, 15 people that are making decisions for all of us. But that you're right there. Now, you got another clip, or was that the last one?
I do have another clip, but I would like to see, and this isn't going to happen, but if there was an honest press conference, Federal Reserve Chairman, whoever, should get up there and say, really, I don't have much control over this. It's really up to Congress and how much deficit spending they're going to do. And if they ramp it up, there's going to be inflation because we're going to have to print a bunch of money. But his job de facto is to go out there and explain in some sort of economic jargon why things are bad.
Now, let's give him some credit too, though. Look, since he started raising the rates, it has slowed things down. I think what you're saying and what I've been saying is, man, if we'd have just controlled quarter raises over the last 24 months would have been a lot better than last year at this time, James, we were at 0. Now the federal funds rate's in a range of 4.5 to 4.75.
Right. We've gone up 4.5%.
And I know, listeners, and it's not your job. You are amazing at what you do. But when you're in the trenches like I am and you see this, I see what this is, the impact it's going to have. Go ahead.
One more clip.
Yep, go ahead.
The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
I mean, it is what it is. I mean, he's 100% correct. I mean, look, the housing industry, our COVID started, and, all these other businesses, right, in 2020 were struggling. The housing industry, COVID started last July. I mean, that's when the interest rates just really took off, skyrocketed, and now we're trying to play catch up. So, look, I get it. It is what it is. That's why, hey, you've got a place to come get that. Don't try to decipher it. You've got a place to come get all that information.